Without growth, there is no value. 1. Invest in growth stocks. The reason you should invest in growth stocks and hold them long-term can be best explained by Philip Fisher's wisdom. If you have invested in the right company, you don't need to worry about when to sell it. If you have done the right work when buying a stock, you may never need to sell it at all. This means that choosing which company to invest in requires extreme caution. The fundamental principle is to find the right company, and if you have confidence in its future, buy and wait. So how do you define the right company? Let's explore this further. 2. Growth requires both speed and sustainability. Philip Fisher's margin of safety concept shows that the slope of an upward trending intrinsic value graph represents the company's growth speed. Ultimately, both the steepness and the sustainability of this growth matter. Peter Lynch once said, "If you own shares in a great company that continues to grow, time is on your side." However, no growth industry can expand indefinitely. At some point, growth slows down, and when that happens, the company can no longer be considered great. This is the ideal time to sell. 3. True growth comes from earnings growth. To succeed in growth stock investing, you must understand true growth, which is earnings growth. Growth does not come from industry, revenue growth. Growth must come from earnings growth. Revenue is the total amount generated from sales. Earnings are what remains after deducting expenses. Only earnings growth drives stock price appreciation. Many companies mislead investors by using temporary hype-driven trends rather than true earnings growth. Examples of such speculative trends include superconductors, NFTs, vaccines without proven profitability. These industries are not true growth stocks until they can demonstrate consistent earnings growth. 4. Not all companies in a growth industry will grow. Being in a growth industry does not guarantee that every company in that industry will succeed. Example, the dot-com bubble. During the dot-com boom, many companies offered cash incentives to users who visited their websites and watched ads. Their business model was to attract users and monetize through advertisers. However, many advertisers were unwilling to pay for uncertain ad effectiveness. User numbers increased, but ad revenue did not, leading to losses. This created an illusion of expansion, causing stock prices to skyrocket. Companies issued more shares to raise capital, but those without profits eventually collapsed. The common trait of dot-com bubble failures: they could not generate earnings. Compare this to gaming companies at the time. Unlike free internet services, games implemented paid services early. This innovation attracted investors to profitable companies, boosting stock prices. Companies that could not compete failed, while those with earnings growth thrived. 5. Without an economic moat, there is no pricing power. The term moat originally referred to a protective trench around a castle, preventing enemy invasion. In business, a moat means a competitive advantage or entry barrier that protects a company from competitors. Key characteristics of strong economic moats: technological superiority that competitors cannot replicate, brand loyalty with highly dedicated customers, capital-intensive industries requiring massive investment. Without a moat, a company cannot maintain pricing power, making it vulnerable to competition. 6. The gap between stock price and true value creates profits. Peter Lynch developed the earnings line, a metric that plots earnings per share and EPS over time. When stock prices rise above the earnings line, they may be overvalued. Time to sell. When stock prices drop below the earnings line, they may be undervalued. Time to buy. Stock prices fluctuate in the short term, but in the long run, they follow earnings growth. Peter Lynch emphasized this principle. For months or even years, a company's performance and stock price may move separately. However, in the long term, a company's success and its stock's success are 100% correlated. The gap between business performance and stock price creates the opportunity to make money. Patience gets rewarded. Holding stocks in successful companies gets rewarded. The key question is, how do you calculate fair value? While exact predictions are impossible, investors must estimate a company's future EPS. The accuracy of this estimate depends on how deeply you study the company. Conclusion: what defines a great company? Sustained earnings growth, not just industry or revenue growth. not part of a speculative bubble. Strong economic moat to defend against competitors. A significant gap between stock price and intrinsic value. Only companies that meet these criteria can be considered true growth stocks.